Hey, hi everyone. Welcome to yet another podcast of India Equity Research. In today's episode, we are going to look at this interesting company which is called Jet Healthcare. This company is currently trading at around roughly 15,000 crore market cap, around 51 times price to earnings ratio, and commands a very profitable 40% return on capital employed. So this company has delivered roughly around 134% return in the last 1 year. And let's find out whether this performance can sustain in the future or not. So for that, let's deep dive into this company's business model, its fundamental analysis, and see if the company is rightly priced in or not. So let's come down and go for the company's earnings call presentation. I'm just opening it up. So here I am, FY25's investor presentation. I'm just going to scroll a bit down and going to find the company's business model. So the company is basically a specialty pharma company which provides healthcare ingredients and intermediates and offers niche products for the global pharma companies. So these are the key three divisions the company has. The first one is the contrast media intermediate division. These are basically agents which are used in medical imaging in use cases like X-rays, CT scans, and MRI scans. So the company supplies critical starting intermediates and several advanced intermediates for producing these contrast media intermediates. So if you look at the market size of contrast media, so there are typically only 4 players in the globe which control 75% of the global market share. And the company has a relationship with the 3 of the largest manufacturers. So this division contributes to roughly around 40% of the company's overall business. This is about the contrast media division. And secondly, if you look at the second division, the high intensity sweeteners. So this business involves development and manufacturing and marketing of saccharin and its salts. So this saccharin is basically used in tabletop sweeteners, oral care products, beverages, confectioneries, and pharma products and everywhere. So the company offers to over 300 customers globally, and the major industries they supply to are FMCG and agrochemical space. So this division contributes to roughly around 13% of the company's overall business in the last fiscal. Moving on to the third and the hero division of the company, the pharma intermediates and API division. So in this division, the company collaborates with global pharma companies and MNCs and provides intermediates that serve as the building blocks for APIs in chronic therapeutic areas. The main therapeutic areas are like cardiovascular system, central nervous system, and oncology. So the company supplies these products to over 56 customers globally, and out of which 40 of them are there in India. So this division is the fastest growing division for the company, and this contributes to roughly around 45% of the company's overall business. If you look at the last fiscal year's overall performance, right? Let's just scroll here. So these are the 3 key divisions which we just talked about. In this, contrast media has been growing at roughly around 3.4% CAGR in the last 5 years. And the high intensity sweeteners is a slightly higher growth business, which is growing at 7.8% CAGR in the last 5 years. And then the third division, which is a hero division, which has grown at around 82% CAGR in the last 5 years. And the majority of the growth has come in the last fiscal year. If you look at the last fiscal, the company's revenue from this pharma intermediates and API division has grown from 94 crore to 462 crores, right? And that had led to a massive jump in the last fiscal year's revenue. So the company is also maintaining a high profitable profile. If you look at the EBITDA margin, it has been consistently trading at 35 to 40%. Last fiscal year, the EBITDA margin was 36%. And even the PAT level also, the company is profitable. They are doing a PAT margin of roughly 29.6% in the last fiscal. So the company is overall growing and the company is highly profitable. So if you look at the valuation picture, I go to the price to earnings chart. The company is currently trading a little bit closer to its overall median valuation range, which is around 48 times. And currently it's trading at 51 times, which is close to the overall long-term median valuations of this company. So it looks like a very decent entry point. And the share price had rallied at around 134%. And given the growth prospects the company is given and the quality and the profitability nature of the company, I think this 51 times PE is justifiable. And we can expect a decent shareholder return from Jet Healthcare in the next fiscal year. So that's it for today's podcast. See you in another interesting episode.